You're 34 years old, and your paycheck reads $280,000 a year. Your friends think you're rich. Your parents brag about you at dinner parties. And right now, tonight, you're sitting on your kitchen floor because your investment account just dropped $91,000 in a single afternoon, and you don't understand how someone who earns this much can also be this broke. That's the part nobody warns you about. The higher the income, the easier it becomes to feel like money problems are for other people. And that feeling is exactly what wrecks you. Rewind 4 years. You're 30. You just got promoted, and your salary jumps from $90,000 to $180,000 in a single year. That kind of jump doesn't feel like a raise. It feels like proof. Proof that you're smart, that you've made it, that you're different from the people still budgeting grocery trips down to the dollar. And that feeling is the first mechanic working against you, quietly, before you've even noticed it. It's called lifestyle inflation, but that phrase is too clean for what actually happens. Your rent doesn't just go up a little, it doubles, because now you can afford the building with the rooftop pool. Your car lease resets to something German. Dinners that used to be $40 become $160. None of it feels reckless in the moment. Every single purchase feels justified, because your income justifies it. That's the trap. Lifestyle inflation doesn't look like overspending. It looks like matching your life to your paycheck, one reasonable decision at a time, until your paycheck owns you instead of the other way around. Here's the number that should have scared you and didn't. At $180,000 a year, you were saving less, in real dollar terms, than you did when you earned $90,000. Your raise had a savings rate attached to it, and that rate went down, not up. Nobody sends you an alert for that. There's no red flag. Your bank account still grows every month, just slower than your life is expanding around it. And slow leaks are the ones nobody patches in time. The crisis moment comes 8 months later, at a dinner with 2 friends from residency. One of them, making half what you make, mentions almost casually that his index fund portfolio just crossed $200,000. You laugh it off at the table. Alone in your car afterward, you open your own brokerage app for the first time in 5 months. $14,000. That's it. $14,000. After 4 years of a 6-figure income. Because every spare dollar had already found somewhere else to go before it ever reached an investment account. That's the cost of level 1. Not the $14,000 itself. The 4 years you can't get back. The 4 years compounding never got the chance to work on your behalf. Because your money had a dozen other jobs before investing ever got a turn. So you fix it. Or you think you do. And that's where it gets worse, not better. You're 31 now, sitting in that same car, except this time you're angry instead of embarrassed. And anger makes people move fast. You don't build a plan. You don't talk to anyone who actually manages money for a living. You open 3 new apps in a single weekend and move $40,000, almost everything liquid you have, into individual stocks and a handful of options contracts. Because deep down, a part of you believes the same thing that got you the promotion will get you the returns. You believe competence transfers. That earning 6 figures at your job means you must be good at this too. That belief is the second mechanic, and it's the dangerous one. High earners rarely think of themselves as financial beginners, because nothing else in their life requires them to feel like a beginner anymore. So they skip the boring part. They skip the part where you learn what you're actually holding, why you're holding it, and what happens when it moves against you. They go straight to conviction, without ever earning it. For 6 weeks, it works. Your portfolio climbs to $78,000, and every gain feels like confirmation that you were right about yourself. You stop checking index funds. You start checking your app 4 times a day instead, watching numbers that feel like proof you've cracked something everyone else missed. Then the afternoon comes when it doesn't work anymore. And that's exactly where we left you. Sitting on your kitchen floor, staring at a number that's $91,000 smaller than it was that morning, trying to figure out how a person earning your salary could ever end up here. The number on your screen isn't the real damage. The real damage is the $40,000 you moved, sat in a single over-leveraged options position for 11 days, and you didn't know what a Greek was, what implied volatility meant, or why your position could lose 60% of its value while the underlying stock only dropped 4%. Nobody explained that to you before you clicked buy. You didn't ask, because asking would have meant admitting you didn't already know. That's level 3's mechanic, and it's the one that actually separates high earners from everyone else who loses money in the market. It isn't the size of the loss, it's the absence of a floor. You had no stop-loss rule, no position sizing plan, no answer to the question, how much am I willing to lose on this one bet? Because you never sat down and decided the number in advance. You decided it in real time, with your stomach, at 2 in the morning, staring at red numbers on a phone screen in a dark bedroom. Here's the part that stings worse than the number itself. Your friend from residency, the one with the $200,000 index fund, has never made a single trade like this in his life. He picked 3 funds 8 years ago and has not touched them since, other than to add money every single month, automatically, without thinking about it. He earns half what you earn. He has never felt like a genius. He has also never needed to. You sit with that for a long time, long enough that the anger turns into something quieter and more useful. You start asking a different question. Not, how do I make this back? But, what actually happened to the $14,000 I should have had 4 years ago, and the $91,000 I just lost trying to skip the line? The answer is the same for both. You tried to substitute income for a system. Income can buy you options. It cannot buy you discipline. And discipline is the only thing that turns a paycheck into wealth, instead of just a bigger version of the same paycheck-to-paycheck cycle everyone assumes only low earners live in. So level 4 starts here, on a Tuesday, with you doing something almost embarrassingly unglamorous. You open a spreadsheet, not an app, not a broker's dashboard with charts and colors designed to keep you watching. A blank spreadsheet, and you write down every dollar of that $280,000, where it's supposed to go, in order, before it touches anything else. Rent, taxes set aside, an emergency fund you don't currently have. Then, automatically, before you can talk yourself out of it, 20% into index funds you will not look at more than once a month. It feels small. It feels like a step backward for someone who was just trading options with $40,000 2 months ago. That feeling is worth paying attention to, because it's the same feeling that got you into this mess in the first place. The belief that boring is beneath you. 6 weeks into the new system, something happens that surprises you more than either the gain or the loss did. You forget to check your portfolio for 11 days, not because you're avoiding it, because there's nothing urgent to check. The money is already moving where it's supposed to go, without you. That's the moment the second mechanic finally clicks in reverse. The same income that let you inflate your lifestyle without noticing, and let you gamble $40,000 without a plan, is now working the opposite direction. Automated, boring, unwatched, it's finally doing the one thing high income was always supposed to do, and never did until now. It's buying you time, instead of stealing it. 12 months into the spreadsheet, you check the numbers you swore you wouldn't obsess over. Just once, on a Sunday morning with coffee instead of panic. $61,000. Not because of a hot pick, not because of a lucky week. Because 20% of $280,000, moving automatically for a year, does something options never did. It compounds, without asking you to feel clever about it. But level 5 isn't the recovery. It's the test of whether the recovery holds. Your company announces a bonus structure change. $40,000 lump sum, landing in your account in March. And the old voice comes back immediately. The one that made $40,000 disappear in 11 days the first time. It doesn't sound like greed this time. It sounds reasonable. One trade. You know more now. You understand the Greeks now. You've earned the right to try again. You almost do it. You have the app open. A position half built. When you think about your friend and his 3 funds he hasn't touched in 8 years. Not because he lacks conviction. Because he decided, a long time ago, that his job was to earn the income and let the system do the investing, and never let the 2 jobs trade places again. You close the app. The $40,000 goes into the same 20% system as everything else. Untouched, unglamorous, automated, before you can argue with yourself about it. Here's what I want to ask you directly, because I think a lot of you watching this have a version of that account open right now. If a bonus landed in your account tomorrow, be honest with yourself. Would you automate it? Or would some part of you go looking for the trade that finally proves you were right all along? Tell me in the comments which one, because I guarantee you already know the answer before you finish typing it. That's the real cost this whole story has been circling. It was never really about the $91,000 you lost on a kitchen floor at 34. It was about believing, for years, that a high income made you exempt from needing a system. High earners don't usually go broke from spending too much on lattes. They go broke, or close to it, from believing their salary was a substitute for discipline instead of a tool that needs one. 2 years out from the kitchen floor, you're 36 now, and the number in your account has stopped being the thing you check first thing in the morning. That, more than any dollar figure, is the real marker of level 6. Not the size of your portfolio, the absence of your obsession with it. $640,000 sits across your retirement accounts and index funds now. Most of it built the same unglamorous way, 20% moving automatically before you ever see it. But the mechanic worth naming here is the one nobody puts on a thumbnail. It's called the behavior gap, the difference between what an investment actually returns over time and what the average investor actually earns holding it. Because the average investor buys high on excitement and sells low on fear, over and over, and never captures the return that was sitting there the whole time for anyone patient enough to leave it alone. You lived that gap twice. Once when lifestyle inflation quietly ate 4 years of compounding before you'd even opened a real position. Once again when panic and overconfidence tried to erase 2 months of gains in a single afternoon. The market didn't do that to you either time. You did. And once you can actually say that sentence out loud, something shifts, because it means the fix was never about finding better stocks. It was about becoming a person the market couldn't provoke. That's the pivot worth sitting with, because it applies whether you make $40,000 a year or $400,000. Money doesn't reward intelligence. It rewards the specific, narrow trait of doing the boring thing on purpose, repeatedly, especially on the days it feels stupid to. Your friend with the 3 index funds isn't smarter than you. He just made peace, years earlier, with being unimpressive on purpose, and let that unimpressive decision run uninterrupted long enough to become something extraordinary. There's a harder truth underneath that one, and it's this. High income doesn't just fail to protect you from bad financial decisions, it actively hides them longer. A person earning $50,000 a year who overspends finds out fast, because the math breaks immediately and painfully. A person earning $280,000 can outrun bad decisions for years, refinancing the mistake, absorbing it, covering it with the next raise, right up until the day the mistake gets big enough that even a 6-figure income can't out-earn it anymore. That's the version of you that existed on that kitchen floor. Not a reckless person. A person whose income had been quietly subsidizing the absence of a system for so long that the system's absence finally came due all at once. The uncomfortable question this leaves you with isn't about stock picking, or budgeting apps, or which broker has the lowest fees. It's this. If your income disappeared tomorrow, and all that was left was the system underneath it, the habits, the automation, the discipline you built when nobody was watching, would there be anything left standing at all? For some people, the honest answer is, their income was never wealth. It was just a very convincing disguise for its absence, worn for years, right up until something forced the mask off. Go back to that kitchen floor for a second. 34 years old, $91,000 gone in an afternoon, staring at a screen and asking how someone earning your salary could end up here. You know the answer now, and it isn't the one you expected that night. It was never about the salary. It was about mistaking a big paycheck for a finished financial life, when the paycheck was only ever the raw material, not the structure. The version of you sitting on that floor didn't need a better stock pick. He needed a spreadsheet, an automated system, and about 18 months of getting comfortable being unimpressive on purpose. That's it. That's the whole difference between the man who lost $91,000 in an afternoon and the man 2 years later checking his accounts once a month out of habit instead of dread. So here's the question I actually want you to sit with, not just watch. Somewhere in your life right now, there's a version of that kitchen floor moment waiting to happen, and it's usually hiding behind the exact thing you're proudest of. Your income, your promotion, your title. The thing that makes you feel like the rules that apply to everyone else don't quite apply to you. What is that thing, for you, specifically? Answer that honestly in the comments, because naming it is the only way it stops running your decisions from the shadows. If you've ever opened a trading app at 2 in the morning and felt that specific mix of shame and adrenaline, you already know exactly what this video was really about. Hit subscribe, because this channel exists for exactly that moment, the one where income and discipline stop lining up, and somebody has to tell you the truth about which one actually builds wealth. And if you're earning well right now, but have genuinely no idea what percentage of it is actually going toward your future instead of just your current lifestyle, go watch the video I made on the real math behind lifestyle inflation. It'll show you the number most high earners are too afraid to calculate. And if you're on the other side of this, already burned once by a trade you weren't ready to make, watch the one right after this, on rebuilding a portfolio without repeating the same mistake twice. Both of those are exactly where this story picks back up.